What is a financial bubble, and why do they keep happening throughout history? A financial bubble occurs when the price of an asset rises far beyond its real or intrinsic value, driven mainly by excitement, speculation, and unrealistic expectations rather than solid fundamentals. During a bubble, people don't buy because something is truly worth more, but because they believe they can sell it later for an even higher price. Financial bubbles usually follow a clear pattern. First comes a new opportunity. This could be a revolutionary technology, a new market, or an economic shift that captures public attention. Early investors see real potential and prices begin to rise. Then comes the boom phase, where media coverage increases, success stories spread, and more people rush in, afraid of missing out. This fear of missing out, often called FOMO, pushes prices even higher. As the bubble grows, speculation replaces logic. Investors stop asking, "Is this asset worth this price?" and start asking, "How fast can I sell it for a profit?" Borrowed money often enters the picture, increasing risk. At this stage, prices become disconnected from reality. Warning signs are ignored, and skepticism is dismissed as negativity. Eventually, the bubble reaches its peak. At some point, confidence weakens. This could be triggered by bad news, rising interest rates, or simply the realization that prices cannot keep rising forever. When investors start selling, panic spreads quickly. Prices fall sharply, leading to the burst of the bubble. Those who entered late often suffer the biggest losses. History is full of famous financial bubbles. The Dutch Tulip Mania of the 1600s saw tulip bulbs sell for the price of houses. The dot-com bubble of the late 1990s caused internet company stocks to skyrocket before crashing in 2000. More recently, the 2008 housing bubble showed how overconfidence and easy credit can damage the entire global economy. Financial bubbles matter because their collapse can lead to job losses, bankruptcies, and long-lasting economic pain. Understanding how bubbles form helps investors recognize warning signs, think more rationally, and avoid emotional decision-making. In the end, financial bubbles remind us of a simple truth. Markets are driven not just by numbers, but by human psychology. Greed, fear, and optimism can be powerful forces, and when they get out of control, a bubble is born.